You want to start investing, but afraid of the risk involved in it. One thing you have to understand is that you cannot avoid risk if you're looking to make money. Although there are ways in which the risk can be reduced and overcome. By developing strategies and choosing the right financial markets, one can increase their chances to make more profits and face less losses. Adding mutual funds to your investing portfolio is a great way to do this. Mutual fund is considered to be one of the most prudent markets out there. Bearing a very low risk and generating decent returns makes it a great investment for many. But what makes it a safe market? To understand this, you need to know how it works. According to an article from Wikipedia, mutual funds originated during the 18th century. Adriaan van Katwijk, a Dutch merchant who had established the first mutual fund in the year 1774. And the first modern mutual fund industry had begun during 1924 in the US. The main principle of mutual funds is to make your investments diverse. We know that diversifying your investments reduces risk substantially. So instead of investing in a single stock or bond, they do it in multiple select ones that are analyzed by experts, which seem to be more exuberant, as it would minimize the adverse impact of a single investment. Moreover, it pools your assets along with other investors, resulting in holding a larger position in other stocks, which in turn gives higher rewards. From this information, we can say why mutual funds seems to be a lovely market to begin your investment journey. Not only this, but mutual fund provides other advantages too. It offers advanced portfolio management, in which a fraction of your investment, a relatively small amount, is took as fees to hire an expert portfolio manager who provides professional help in managing it. It even offers services that automatically reinvest your profits from dividends and interest, making it very convenient. There are a few terms that you'll need to know before investing in it. I'll explain about a few of the important and basic ones that'll help you understand it better. Okay, so first we have liquidity. I'm sure most of you know it, but liquidity in mutual funds is the ability to redeem the investment on any business day without having to go through any hassle. Next, we have net asset value. The price of the share of a mutual fund at which it can be redeemed is known as its NAV. The NAV of a mutual fund is calculated by a simple formula: the value of assets subtracted by their liabilities, which is divided by the number of shares issued by the fund. The NAV is calculated on a daily basis. Although the NAV of a mutual fund is irrelevant as it does not indicate anything about the fund's growth, a money market fund is a type of mutual fund that maintains its NAV at $1 per share. I'll talk about the types of mutual funds within a few minutes. The third word is 12B, one fee. It is basically a fee that the fund charges in order to cover distribution, marketing, and selling costs. This is included in the expense ratio of a fund, and usually a good fund would have its expense ratio between 0.5% to 0.75%, and anything above 1.5% is considered to be high. The next word is XIRR. It is the extended internal return rate, which basically gives us a measure of the returns from the fund. IRR is usually used for irregular cash flows and gives a much more detailed information of complicated investments, whereas CAGR is used for a single investment over a period of time. XIRR is mainly used in SIP and CAGR for lump sum investments. SIP and lump sum investments are two methods of investing in mutual funds. A SIP, abbreviated Smart Investment Plan, is a method of investing in which the investor invests a predetermined amount for a regular time interval. SIP works on the principle of compounding, so if you invest in it for a longer time, you'll get much more returns. You can use SIP calculators, which are available online, or reach out to a professional who might help you, or even DM me personally for a good SIP. A lump sum investment is a one-time investment in which the investor is comfortable with risks and hence invests a large amount at once. It provides higher returns but come with a risk factor, which is more than an SIP. Now, apart from all these, there are three main types of mutual funds, each offering their own advantages and containing variable risks. First, we have equity fund, and then a bond fund, and the last a money market fund. Equity funds or stock funds are basically mutual funds that invest in company stocks, which means you become a part owner of each security and fund's portfolio. Whereas bond funds, as its name suggests, are mutual funds that invest in bond securities, and are much less volatile as compared to stock funds. There are mutual funds which invest in both and are known as hybrid mutual funds. A money market fund invests in short-term securities such as IOUs, and most of these securities have a maturation date of less than a year. Both equity and bond funds have NAV that keep varying, but a money market fund maintains its NAV at $1 per share. This makes it hard to make much profits over a short term in money markets, as it won't be a good investment to keep up with inflation. Most money markets do a great job at maintaining their NAV at $1, but there were a few cases in which the funds broke the buck, meaning dropped their NAV below $1. A money market fund known as the Reserve Primary Fund broke the buck back on September 16, 2008. Its price fell below $1 due to the bankruptcy of the Lehman Brothers, an investment banking company. This resulted in immediate liquidation of all the assets they owned before the situation got exacerbated. But the problem with mutual funds is that, due to its really low risk, it doesn't provide much rewards. Many mutual funds have high expense ratios and sales charges, and even after getting returns, there will be taxes, making it a not-so-good investment to keep up with inflations too. However, if you're looking for a safe investment and not willing to take up on much risk, then you can consider adding mutual funds to your portfolio.